Hi guys, welcome back. Today we're going to talk about debt or leverage and the impact that it has on your business and the things that you should think about before taking on some debt for your business. So let's get into it. So what is debt? Debt is essentially borrowed money. Now, there's a few ways of financing a business. There's equity, and equity is the money that the shareholders or the owners of the business put into the business. And there's no contractual obligation for the business to pay back this money. Now, of course, the owners of the business or the shareholders, they expect a return on their investment. But the business does not have to pay back this money. If the business were to go under, then the shareholders would lose all their money. The second way we can finance a business is debt, which is essentially borrowed money that now has to be paid back. So you'd borrow money from a financial institution or a bank, and then you'd have to pay it back. And then the third source of funding would be hybrid instruments such as preference shares. Now, these ones have the qualities of both debt and equity, but we'll talk about those in another day. So debt is essentially borrowed money that you use to finance your business. So what are the things that you have to think about when you're taking on debt for your business? So the first thing is obviously the cost. The people who are lending you this money expect a return on the investment, so they're going to charge you certain fees. So the first and obvious cost is the interest expense. So the interest is charged as a percentage on the amount that you've borrowed. So interest could be either fixed or floating. A fixed interest rate basically means that it's set at the start of the loan and it never changes. A floating interest rate tends to change periodically, say every 3 or 6 months or every year. So a floating interest rate will be set as a base rate plus a margin. Now, the base rate is what keeps changing. The margin stays the same. So the base rate could be based on something like SOFR, the Secured Overnight Financing Rate, which is the rate at which banks in New York will borrow from each other overnight. Or you could have something like the Euribor, or you could have something like the central bank base lending rate. So whatever it is, it's a rate that will keep changing every 3 or 6 months or every 12 months. And then you'd add a margin to that. So for example, if you take on a loan that is SOFR plus, say 2%. So if SOFR is at 5%, that means your interest rate will be 5% plus 2%, which is 7%. If SOFR happens to reduce to say 2%, then your interest rate becomes only 4% because it's going to be 2% plus 2%. So there's pros and cons of both fixed rates and floating rates. The fixed rates give you certainty, you know what you're going to pay for the entirety of the loan. The floating rates are less certain, but then you get to benefit from any decreases in interest rates. But on the flip side, if the interest rates are to go up, then you end up paying more. The second thing that the lenders will charge you is upfront facility fees. These are fees that they charge you for basically arranging the financing for you. So it typically tends to range between 1 and 2% of the total loan amount, and you have to pay this at the start of the loan. The third thing that they might charge you is commitment fees on undrawn amounts. Say you get approval for a loan of $10 million, but you only draw $8 million. So that means that there's some $2 million that you're yet to draw down. So the lenders will tend to charge you a percentage of that $2 million that you haven't drawn down. And the rationale here is that they've made this money available to you, so they theoretically can't lend it to someone else. So even if you've not drawn it down, you could come to them at any time and ask for it. So they're keeping it aside for you, and they charge you a fee for that. So that will be, say, 1% of that 2 million or 1% of whatever amount it is that you have not yet drawn down. The fourth thing that they could charge you is legal fees. There tends to be legal fees associated with borrowing money. So there is legal fees for drafting the financing contracts. If it's a secured loan like a mortgage on a house, the lender will have to register a charge on that property. That incurs legal fees as well. So what the lenders will typically do is push these legal fees over to you, and you'll have to pay them. So these legal fees could range, anywhere from say 0.5% of the loan amount, and once again you have to pay this upfront. So when you're thinking about the costs of borrowing, it's not just the interest expense, which is the obvious one. There's all these costs that come with it that we've just discussed. Feel free to comment below if there's any other cost that you could think of that we've not covered here, and remember to subscribe. Then the second thing that you have to think about when you're taking on debt is the repayment cadence for both interest and your principal. Now this is borrowed money, so you have to pay it back. You have to pay the interest and you have to pay the principal. Interest tends to be more straightforward. It's paid periodically. So Could be paid every month or every 3 months or every 6 months. For principal, there's a few ways. So there's what we call amortizing loans. Amortizing loans are those loans that you have to pay periodically. So you'd either pay them every month or every 6 months or every 12 months. And then you have bullet repayment loans. So bullet repayment loans, you'd pay the entire amount of the principal at the end of the loan term. Now, it's important for you to think about the repayment cadence because it affects your business cash flows. You have to be sure that when the repayments are due, you have that money available to pay, because of course if you don't pay, that leads to default, and that's not good for your business. So in the case of amortizing loans, because they're the ones that tend to be more heavy on your cash flows, one thing you could do is negotiate a principal repayment holiday. So this is basically a period between the disbursement of the loan and when you actually start making the principal repayments. So you could negotiate for something like a 12-month holiday. So that means that for the first 12 months of the loan, you never have to pay any principal, and that will give you some time to use the money and set up your cash flows properly. The third thing that we need to think about when we are taking on debt is our drawdown cadence. So for most loans, you tend to draw the entire amount of the loan at the start. However, there's instances where you might want to or you might have to draw down in bits. So for example, a working capital loan for your business that is tied to production. That means that when you hit a certain level of production, you draw down part of the loan. When you hit a higher level of production, you draw down another part of the loan. Or something like a construction loan that is tied to completion. Say when you hit 20% completion, you draw down a certain part of the loan. When you hit 40% completion, you draw down another part of the loan. So you're drawing it down in multiple tranches. Now this tranching is very important for you to think about. There's no point in you drawing down the entire amount of the loan at the start when you don't need that money at the start, because you're just going to be incurring interest for that period. So if you look at your business and you realize that actually what I need is multiple tranches, then structure those multiple tranches with your lenders. There's no point in drawing down the money at the start and you don't need the money at the start. Then the fourth thing that we need to think about is the restrictions that the lenders will place on the business as a result of providing the financing. So these restrictions are what we call covenants, and the lenders will want to place these restrictions to protect their investment. They want to be sure that you will pay them back. So they'll want you to do certain things or to not do certain things. And the most common restriction is limiting the amount of new debt that the business can take after the lenders have given you this loan. So the more the debt that the business has, the greater the financial risk, the greater the risk that the business will run into problems and fail to repay these loans. So what the lenders want to do is limit the amount of new debt that can be taken. And they typically do this by specifying certain ratios that have to be complied with. So these ratios are what we call gearing ratios, and they measure the level of debt or the level of financial risk in your business. So we have things like the debt to equity ratio. The debt to equity ratio basically compares the amount of debt that you have in your business with the amount of equity. The more the debt that you have, the higher your debt to equity ratio, and that means the higher your financial risk. So the lenders will typically specify a maximum amount of this debt to equity ratio. And there's various iterations of this. There's a debt to capital ratio, there is a loan to value ratio, but they all do the same thing. They specify the amount of debt that is in the structure, and the lenders will specify a maximum amount. So they could say your debt to equity ratio should not go above, say, 50%. You could have the interest coverage ratio. The interest coverage ratio shows the extent to which the business is making enough money to cover the interest expenses. The lenders want to be sure that you're generating enough profits to cover the interest expense, because if you're not, then that means that you could default. So the lenders will typically specify a minimum amount of your interest coverage ratio. So they could say something like your interest coverage ratio should not go below 1.1. And then we have the debt service coverage ratio, which looks at the cash flow that is available for the repayments of both the principal and the interest. Now, earnings are not equal to cash flows, and we can discuss that in detail some other day, but earnings are not equal to cash flows. So while the interest coverage ratio that we discussed earlier will look at the earnings, the debt service coverage ratio will look at the cash flows. So they want to look at whether you're generating enough cash to pay your interest and your principal. And typically here they'll also specify a minimum amount. So they'll say something like your debt service coverage ratio should not go below 1.4. Then we have something like the current ratio, which compares the level of your current assets and the level of your current liabilities. So the thesis here is that you should have enough short-term assets that you could theoretically liquidate and use that money to pay off your short-term liabilities, which will include your interest and your principal repayments on the debt. So all these ratios put together, when they specify maximums and minimums, what it basically forces you to do is think about the new debt that you're taking on. Because every time you you think of taking on some new debt, you have to be sure that you're complying with the old covenants. And if you're not complying, then you can't take on the new debt. So this limits the amount of new debt that you could take. Then the other restriction that they could place on you is limiting the seniority of any new debt that you might take. So if you decide to take on new debt, the old lenders will specify that that debt is junior to them. What this means is that in the worst case scenario where your business is being liquidated, there's a payment schedule, there's an order of who gets paid first. And the old lenders will specify that since they are the senior most lenders, they get paid first, and whoever came after them will get paid later, because sometimes there might not be enough money to pay everyone in the case of a liquidation. So they limit the seniority of any new debt that you're bringing into the structure. Then they might require you to provide information periodically. So this could include something like your management accounts that you must provide, say, every quarter, or your audited accounts that you must provide every year. So they want to look at your financial performance so that they can be sure that you're still in a good position to pay, and also to make sure that you're in compliance with the covenants that we discussed earlier. Then they might require you to take certain actions in your business depending on the type of lender. If it's a lender who's very interested in ESG and, say, climate change, they might force you to use more renewable energy in your business as part of the condition of the loan or of the drawdown. And then the lenders might also require you to seek their consent before you take certain major actions, because they want to protect their interests. So for example, they might require you to seek their consent before you merge with another business or you acquire another business. They might require you to seek their consent before selling a major portion of your assets, or even issuing new shares to new shareholders. They basically want to preserve the structure as it is so that they can be sure that their money gets paid. So you'll see that all these restrictions will limit the things that you could do or not do in your business. So before you take on that debt, you have to think about whether these are things that you are willing to accept. And then the final thing that we need to think about when you're taking on debt is the impact on our financial statements. So all these things that we've discussed above, they will have to appear on your financial records or your financial statement. Your costs tied to the loan, so your interest, your commitment fees, and the like, will have to appear as an expense in your income statement. Your debt repayments and your interest repayments will have to be shown as cash outflows in your statement of financial position or your balance sheet. Your unpaid debt will have to be shown as a liability on your balance sheet, and you'll have to split this between the non-current liability and the current liability. The non-current liability is basically those debts which are due more than 1 year from the relevant date that you're reporting, and the current liabilities are those debts which are due within 12 months of the date that you're reporting. So you'll have to disclose all of these things in your financial statements. You'll also have to disclose other things such as the major debt terms, the securities that you've given to your lenders. You'll have to provide a schedule of how the debt is going to get repaid, and you'll have to give explanations of the covenants that the lenders have put on you, and you'll have to say whether or not you're compliant with them. So there's a lot of disclosure requirements that come with taking on additional debt that you'll have to comply with. Right, thank you so much for watching. Please remember to like the video. Please remember to share it with your friends. As always, if you subscribe, that will be super helpful to us, to help us reach more people. We also have a newsletter that is basically the written form of these videos. The link is below. Please consider subscribing to that. It's completely free. If you'd like to access some free Excel templates and a fully customizable financial model, the link is also below. Thank you so much for watching, and see you in the next one.